Hey friends, welcome back to the channel. I'm Iggy, your friendly guide to all things finance, investing, and growing your wealth. If you're new here, welcome to the Investing Iguana. This channel is all about making complex financial topics simple and relatable, especially for us Singaporeans. By the way, we've been ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with over 768,000 reads and 53,000 likes. With more than 650 videos and 300,000 watch hours as of December 2024, we're here to help you make smarter money decisions. Today's topic is a big one. Should you invest in Singapore Exchange Ltd, SGX, now that it's trading at $14? SGX is a cornerstone of Singapore's financial ecosystem, but with its price near an all-time high, is it a smart buy or an overpriced risk? Let's break it down together so you can decide if this stock deserves a spot in your portfolio. First off, why is SGX such an important company? Think of SGX as the financial heart of Singapore. It operates the stock exchange and facilitates trading in equities, derivatives, and fixed income products. Essentially, it's like a giant marketplace where people buy and sell investments. For us in Singapore, owning SGX shares is like owning a piece of this entire ecosystem. It's not just a company, it's a key part of how our financial system works. Now let's talk about its current valuation. At $14 per share, SGX is trading near its historical peak. This reflects optimism about its future growth. But here's the thing. Optimism doesn't always mean reality. At this price point, SGX has a price-to-earnings (PE) ratio of 25. What does that mean? Simply put, investors are paying $25 for every $1 of profit SGX makes annually. That's higher than many other companies in the same industry. So before you jump in, ask yourself, is SGX likely to grow enough to justify this premium price? One reason investors are optimistic is SGX's diversified revenue streams. Unlike some exchanges that depend heavily on equity trading volumes, which can be unpredictable, SGX has expanded into areas like foreign exchange and commodities trading. This diversification makes it more resilient during market downturns when fewer people are buying or selling stocks. For example, in FY 2023, SGX reported a 30% increase in net profit thanks to its broader revenue base. That's impressive growth for any company. Let me give you a real-world example to illustrate this point. In 2020, SGX acquired BidFX, a foreign exchange trading platform. This wasn't just about adding another revenue stream, it was about preparing for the future. Within 2 years of the acquisition, FX trading revenue grew by 20%. This helped offset declines in equity trading during volatile periods when markets were shaky. It's like having multiple sources of income. If one slows down, another can pick up the slack. But before we get too excited, let's consider some risks and challenges SGX faces. First up is competition from other regional exchanges like those in Hong Kong and Tokyo. These exchanges are aggressively expanding their offerings to attract international listings and trading activity. For instance, Hong Kong has been actively courting Chinese tech companies for IPOs, a space where SGX has struggled to compete. Then there's the regulatory landscape. Changes in regulations could impact how SGX operates or affect its profitability. For example, stricter rules on derivatives trading could make it harder for SGX to grow that part of its business. We also need to think about macroeconomic factors like inflation and interest rates. Rising interest rates can dampen investor sentiment and reduce trading volumes across markets. If fewer people are trading stocks or derivatives, SGX's revenues could take a hit, even with its diversified business model. Another thing to keep in mind is the current valuation itself. At $14 per share, there might not be much room for short-term upside if growth slows or market conditions worsen. It's like buying a property at peak prices. You're betting that values will keep rising. So what does all this mean for you as an investor? Well, if you're looking for stability and long-term growth potential, SGX could still be a solid choice, especially if you value dividends. With a dividend yield of around 3%, it offers steady income that can complement other investments in your portfolio. But if you're more focused on short-term gains or worried about overpaying for growth that may not materialize quickly, it might be wise to wait for a better entry point. Remember, investing isn't just about finding good companies, it's also about buying them at the right price. To wrap up today's discussion, investing in SGX at $14 comes down to your individual goals and risk tolerance. If you believe in its long-term strategy and resilience through diversification, and you're okay with paying a premium for quality, then this stock might be worth considering even at these levels. However, always do your due diligence before making any investment decisions. Look at your overall portfolio strategy and consider consulting with a financial advisor if you're unsure. Thanks so much for tuning in today. If you found this video helpful, don't forget to give it a thumbs up and subscribe for more content like this. And if you want to learn more about dividend investing strategies in Singapore or other regional opportunities that could complement your portfolio, check out my video on top dividend stocks for Singapore investors. See you next time.